today we're living in one of the biggest kind of economic financial experiments to date. Central banks around the world are printing money at an exponential rate, which is in effect devaluing your cash, which is kind of when the cash point comes in. Interest rates are at all-time lows. Debt is sky high around the world. I mean, if we look at Italy in terms of debt to GDP, we look at where the US is now skyrocketing its debt to Greece, etc. Arguably, this bubble, this expansion in the market that we've seen, and you go back to your kind of graph, what you probably talk about from 1929 to something like 1935, that, you know, that deflationary period, arguably we are entering into that now. And I know you'll probably have a point of view on deflation and the role that can play in terms of your wealth, but, you know, what's your perspective today in terms of this experiment that's going on? We are in uncharted waters, and what does that mean for the average investor, and also the investors that are so adept with the market and have so much wealth? You know, these guys have got a bit more of a view on it. So what does that mean for the two?
Yeah, agreed. So here, a lot of the question, if I'm understanding correctly, is pretty much exploring this worst case scenario possible, right? Where we're seeing the economies collapsing, a deflationary environment, etc. So we can look at, to inform our discussion, we look at two events. The first one is the 2008, the more recent one, financial crash, where, again, just taking a step back purely from a stock market perspective, despite Lehman Brothers and a lot of big banks facing a ton of pressure, you had a stock market crash from top to bottom of 50%. Within 12 months, we all forgot about it, and it was up by 69%. So you would have brushed it all off within a year. Now let's look at the worst possible scenario, and we're talking about the 1929 crisis, where it represents a lot of that environment that you were talking about. You had deflation, you had a lot of people, unemployment was through the roof. So let's look at that period. If you want to understand how did your portfolio perform in that period, you have to look at deflation, as you said, and we'll talk about that. But you also have to look at dividends and your dividend yield. So here we're taking more of a so I guess for investing one-on-one, dividend is when companies are paying out their shareholders a certain amount on a quarterly or any other basis. So from a deflation, the first thing is that, let's say now we're paying for our Netflix, for our food, Deliveroo, whatever it is. A lot of these prices will start to go down as a result of supply and demand mechanics. So by definition, you start to see that you don't need that much or as much money to buy for these expenses. The second thing you need to adjust for when you calculate your real return is dividends. When we looked at the studies of how did investment in stocks compare and how did they behave in that environment, you started to see that companies were continuing to pay out dividends. And even if the dividends were lower, on a percentage basis, you had something called the dividend yield, which is the dividend divided by the stock price. You started seeing dividend yields of like 7-8%, where typically they're much lower than that. So what is that telling you? It means that you have a higher dividend yield. So your return is actually, you're reinvesting your money into the stock while it's going down. So by the time that it went up, you'll see the same trend that even if you were investing in the worst possible time in the 1929 crash, which is the worst time you could be investing, you would have still seen the same trends when that $10,000 will later on be somewhere between $500,000 if you had invested systematically $100 a month. So I'm throwing out a lot of numbers there, but the main message of what I'm trying to tell you is that even when we looked at the worst possible case scenario in almost 100 years of investing, and we relive it, everything we've been saying still applies. It's a great buying opportunity if you're systematic about it and you invest regularly. Even if it's going down, if anything, it's a good thing, because you are buying at cheaper prices, you're reinvesting your dividends, and you come out of it much stronger.
Although arguably in 1929, the market situation today is slightly different in the sense of where the fiat world, and I think this is going to bring me on to my second question, you know, in the fiat world where, you know, money has basically been printed and the value of your dollar or currency has gradually decreased over time. So your purchasing power has fallen through the floor. Now, I know in 1929, that was when it was a bit different, where your purchasing power increased because the prices dropped. significantly. But in terms of kind of where you see it moving forward, and I'll launch into the crypto space. What's your perspective on the trends that you're seeing in the finance world when it comes to cryptocurrencies and the role that they're playing in people's portfolios?
Yeah, so I guess when the crypto bubble or a lot of the hype happened, a year and a half, 2 years ago, I would say, a lot of our clients or prospective clients were saying, "What's your view on it?" So it's a bit of a boring answer, but we like to differentiate between investing and speculation. So with Sarwa, what you can expect at any point is that we are in the business of securing your financial future and making sure that you reach your goal, whether it's children's education, retirement, etc. When you're talking about goals that are that big, such as retiring early, making sure that you have enough money to pay for your 40, 50K salary once you're retiring, whatever it is, whatever lifestyles you want to work with. When it comes to that, we're talking about value investing, diversification, investing in 10,000 companies that we know what their cash flows, we know more or less how they are going to behave. So cryptocurrencies don't fall yet into that bucket. They're still very speculative in nature. The volatility that we see in cryptocurrencies and Bitcoin as an example is crazy. So this is not the sort of instrument that we can work with to make sure that you are going to increase your capital over time with a good enough confidence that you can bet and work towards a plan. So anything it's speculation in general will have a lot more thrill. You're here. It's a lot more. It's a lot of taking certain bets, taking a much higher amount of risk. So in general, however, so with all that being said, while we don't get into cryptocurrencies and Bitcoin, it's unreasonable, especially when our clients are people like us, and most of them are in the 35 to 45-year-old range. It's unreasonable to ask them to completely dismiss, ignore that. A lot of them are excited about technology. They're excited about new developments. So what we always say is, if you're really excited about it, go for it, but don't have it exceed 10% of your wealth, so that in case it pays off and you took that bet with it, great. In case you lose it, well, you paid for your passion and for your for the thrill that you got throughout. So it's much similar to. Yeah.
Do you own any cryptocurrency?
Yeah, I needed to ask that too. Do you own any?
I don't. I got in. I was too late. I missed the wave. So.
Well, now's a very good time to invest. If you want to get let's
stagger.
Yeah, average dollar buy. Exactly. But I mean, it's interesting. You talk on the reason cryptocurrency comes up to an extent is also when we talk about inequality and we talk about the wealth gap. The access to the market. Cryptocurrency almost is that decentralized bet against kind of that centralized system, which over time has created mass inequality and a huge wealth disparity with people. So it's kind of an interesting topic when it comes to trying to change the system or give the bottom 50% of society or more a chance in. But as you say, it's speculative.
I don't know if I disagree with that, Stephen, because I feel like it's our model is a lot of get rich slow, and it's like proven, it's boring, wait it out, and you're gonna make serious money in the long term, but in the short term it's gonna be quite boring. Speculation, you're right, it has the power to completely bring up certain people to amass a lot of wealth, but I feel like when I talk to some of my friends that have invested and missed out or sold too early, or even in the news, you have people that have committed suicide from going from
volatility goes both ways.
Goes both ways to levels that are insane, and a lot of people jump into companies like Robinhood. They're often seen as I'm giving access to everyone. But you're giving sort of a weapon that you should understand how people might use it in bad ways. So that's why regulators, you'll see them quite defensive on crypto, and they're not trying to be hard on technology. On the contrary, they want to innovate, but they just see their job is to look at what's the worst that can happen and they see a lot of people taking that excitement that you might have, and you're saying, you know what, I'm putting a good amount of wealth. It's not, even if I lose that, I'm not, it's not a devastating impact. But a lot of people unfortunately experience that, wow, I just doubled my money, or I just made a 30%.
That's gambling.
I agree, but like when I looked at when you look at a lot of the crypto charts, some of them can and the amount of time that they got a lot of hype. As you said, you gave the cabin crew, I believe, example where when you know someone is in is getting into that, you're like, wait a minute, that's supposed to be
you don't want to miss out. The FOMO, right? It's you don't want to miss out.
So that's just the difference between investing and speculating that I think is very important. We talked about education. This is a key parameter that we need people to understand, because there's nothing wrong with speculation as long as you understand the level of risk you're taking. You can have the bet, you can look at the fundamentals, you can look at consumer trends and the central banks, but I would still urge people to always differentiate between what is optimistic or opportunistic or speculative in nature versus what is investing in companies like Apple and all the big names.